Every collapse begins with confidence, not panic, not fear, not chaos. Confidence, the kind that fills boardrooms, the kind that dominates headlines, the kind that convinces investors, employees, and the public that a company is simply too big to fail. From the outside, everything looks solid. Stock prices are high. Revenue is growing. Executives speak with certainty. The company is celebrated as a model of innovation, efficiency, and vision. But this is the moment history warns us about. Because the most dangerous phase in any company's life is not decline. It's unchecked success. This is when assumptions stop being challenged. This is when internal dissent quietly disappears. This is when growth becomes a shield against scrutiny. And while the world sees strength, something far more important is happening beneath the surface. The company is beginning to confuse momentum with immunity. In this video, we're not looking at collapse as a sudden event. We're dissecting the early warning signs, the subtle, repeatable signals that appear long before everything breaks. These signals don't scream. They whisper, and the companies that fail are almost always the ones that stop listening. Inside every fast-growing company, success changes the rules. Early on, leaders are careful. Decisions are debated. Risks are measured. But as wins stack up, something shifts. The questions that once protected the company start to feel unnecessary. Why slow down if everything is working? Why challenge assumptions if the market keeps rewarding you? This is how confidence hardens into certainty. And certainty is dangerous. Because certainty doesn't just affect strategy. It reshapes culture. Teams stop pushing back. Middle managers learn which concerns are welcomed and which ones aren't. Over time, skepticism becomes a liability. Optimism becomes a requirement. The company doesn't decide to ignore warning signs. It simply creates an environment where raising them feels unnecessary or unwelcome. From the outside, this looks like alignment. Internally, it's something else entirely. It's the slow removal of friction, the very thing that once kept the company sharp. By the time leadership realizes debate has disappeared, the blind spots are already locked in. Contrary to popular belief, failing companies are rarely unaware of their problems. The data is almost always there, buried inside dashboards, hidden in footnotes, explained away in meetings. Margins begin to flatten. Customer acquisition costs inch upward. Forecasts require slightly more adjustments each quarter. None of these changes trigger alarms on their own. That's what makes them dangerous. Instead of being treated as signals, they're reframed as stories. Temporary, external, fixable later. Over time, leadership becomes fluent in justification. The narrative becomes stronger than the numbers. And here's the critical mistake. Companies start managing perception instead of reality. Internally, this creates comfort. Externally, it maintains confidence. But structurally, it accelerates fragility. Because when small problems are consistently minimized, they don't disappear, they compound. And when the data finally becomes impossible to ignore, the company has already lost the time it needed to respond. Rapid growth is often treated as proof of health. New markets, new hires, new products. Expansion feels like momentum. But growth doesn't strengthen a company by default. It tests it. Every layer added increases complexity. Every shortcut taken during scale creates future debt. Processes that worked at one size quietly strain at another. And here's the trap. Growth buys silence. As long as revenue is rising, inefficiencies are tolerated. Operational strain is reframed as growing pains. Leadership assumes systems will catch up later. But systems don't catch up automatically. They must be redesigned deliberately, or they fail under weight they were never built to carry. Many companies don't collapse because they shrink. They collapse because they grow faster than their foundations. And the market rarely notices. Until that foundation finally gives way, risk doesn't announce itself. It blends in. The most dangerous risks look reasonable. Slightly more leverage, slightly looser assumptions, slightly more reliance on future conditions staying favorable. Each decision feels defensible on its own, but risk compounds silently. especially when no single person owns the full picture. Departments optimize locally. Incentives reward short-term performance. And leadership sees confidence everywhere, without realizing that confidence itself has become systemic. This is how organizations drift into exposure they never consciously accepted. No reckless moment, no dramatic mistake, just a slow normalization of fragility. By the time leadership asks, how exposed are we really? The answer is already uncomfortable. Eventually, the environment changes, not dramatically at first. Interest rates adjust. Demand cools slightly. Assumptions stop lining up as cleanly as before. These shifts are normal. Healthy companies absorb them. Fragile ones expose themselves. Suddenly, decisions that relied on perfect conditions feel tight. Margins thin faster than expected. And leadership begins asking the wrong question. How long until things return to normal? Because this assumes the problem is external. It isn't. The environment didn't break the company. It revealed it. This is the phase where denial is most tempting. Adjust forecasts. Reframe messaging. Buy time. But time at this stage is no longer neutral. It's working against you. The most dangerous warning signs in business do not arrive loudly. They don't crash through the door. They don't flash red lights or trigger emergency meetings. They whisper. They appear as small inconsistencies. Numbers that technically still work, but no longer feel right. A model that requires just a little more optimism to hold. A forecast that depends on conditions staying perfect forever. And inside the company, people notice. Analysts notice. Engineers notice. Finance teams notice. But noticing is not the same as stopping, because the signals are inconvenient. They challenge the plan. They complicate the story. So instead of being treated as alarms, they're treated as noise, adjusted, reframed, deferred to next quarter. And slowly, almost imperceptibly, the organization trains itself to live with unease. This is how failure begins, not with denial, but with tolerance. At this stage, the company still looks healthy from the outside. Confidence remains high. Messaging is clean. Leadership sounds certain. But internally, decision-making has shifted. The goal is no longer to ask, is this strategy correct? The goal becomes, how do we justify continuing? Optimism, once a strength, turns into a shield. Risks are acknowledged only if they can be neutralized with language. Concerns are allowed only if they come with reassurance attached. This is where reality starts losing votes. Because optimism feels productive. It keeps morale high. It keeps investors calm. It keeps momentum alive. But optimism does not change math. It does not slow costs. It does not reverse compounding losses. It only delays recognition. And delay is not neutral. Delay quietly multiplies consequences. Every major collapse passes through a silent threshold, a moment where reversal is still theoretically possible, but practically unbearable. By now, too much capital is committed. Too many public promises are made. Too much identity is tied to the strategy. Pulling back would mean admitting that confidence was misplaced, that leadership misjudged risk, that the bet was wrong. And so the organization continues forward, not because forward is safe, but because stopping feels worse. This is the point where collapse stops being avoidable and starts becoming inevitable, not because the market is cruel, not because competitors are smarter, but because correction now costs more than leadership is willing to pay. From here on, every decision compounds the same direction, and when the failure finally becomes visible, the world will call it sudden. It never is. It is the final frame of a very long sequence. The most dangerous warning signs in business are never dramatic. They don't arrive with sirens. They don't trigger headlines. They don't demand immediate action. Instead, they arrive quietly, disguised as almost normal. Numbers that still look acceptable, but only if you stop asking hard questions. Growth curve that flatten just enough to be explainable, but not alarming. Assumptions that still technically work, as long as nothing unexpected happens. And this is a trap, because nothing unexpected ever stays unexpected forever. Inside the company, people feel it before they can prove it. Analysts notice the margins tightening. Engineers notice systems under strain. Finance teams notice forecasts becoming fragile. But fragility doesn't stop operations. So instead of being treated as warnings, these signals are absorbed into routine, explained away, adjusted slightly, filed under monitor closely. Over time, the organization adapts, not by fixing the problem, but by learning to live with discomfort. This is how collapse begins, not with panic, not with ignorance, but with quiet acceptance. At this stage, the company still appears strong from the outside. Leadership sounds confident. Presentations look polished. Projections remain optimistic. But something subtle has changed internally. Decision-making is no longer driven by truth. It's driven by momentum. The question stops being, is this still the right move? And becomes, how do we justify staying the course? Optimism, once fuel, turns into armor. Risks are acknowledged only if they can be neutralized with language. Concerns are welcomed only if they come with reassurance. Meetings become exercises in confidence maintenance. The goal is no longer clarity. The goal is continuity. But optimism does not alter economics. It does not reduce cost structures. It does not fix flawed incentives. It does not reverse compounding exposure. It simply delays recognition. And delay is not harmless. Delay converts manageable problems into structural ones. What could have been corrected quietly now requires public acknowledgement. What could have been slowed now demands reversal. And reversal is the one thing large organizations resist most. Every major failure passes through a moment that almost no one names. The moment where stopping is still possible, but emotionally, politically, and reputationally unbearable. By now, capital is committed. Public statements are locked in. Internal incentives reward continuation, not caution. Admitting error would mean rewriting the story. It would mean acknowledging that confidence outpaced reality, that assumptions were fragile, that risk was underestimated. And so the organization moves forward, not because the path is safe, but because turning back feels worse. This is where reversibility disappears, not in a single decision, but through accumulation. Each additional step narrows options. Each delay raises the cost of honesty. From here, outcomes stop being shaped and start being revealed. When the collapse finally becomes visible, the public will call it sudden. Executives will call it unforeseeable. But the truth is simpler. The warning signs were always there. They just never screamed. At some point, reality stops negotiating. Models can be adjusted. Assumptions can be stretched. Narratives can be refined. But numbers eventually become uncooperative. This is the phase where spreadsheets grow heavier. Forecasts widen instead of tighten. Variance stops shrinking and starts compounding. What once looked like noise now forms a pattern. Unit economics refuse to improve. Margins compress instead of recovering. Capital efficiency deteriorates quietly, then persistently. And here's the part most people miss. The numbers don't collapse all at once. They decay, slowly enough to argue with, clearly enough to fear. This is where internal conversations change tone. Fewer bold claims, more qualifiers. Sentences begin with if and end with assuming. The math isn't catastrophic. It's inconvenient. And inconvenient math is far more dangerous than bad math because it invites delay. Delay buys time, but time magnifies exposure. By the time the numbers demand attention, they no longer ask politely. This is the moment insiders remember forever. Not the collapse, but the realization. The meeting where optimism doesn't land. The slide that no one defends aggressively. The pause after projection, when silence does more damage than criticism ever could. Confidence doesn't vanish instantly. It fractures, and fractures spread. Teams begin protecting themselves instead of the strategy. Departments shift from execution to explanation. The question subtly changes again, from how big can this get, to how bad could this be? This is when internal language hardens. Phrases like temporary pressure become structural headwinds. Short-term volatility becomes challenging environment. These aren't just words. They are signals. Signals that belief has weakened, even if behavior hasn't caught up yet. Externally, the company still looks composed. Internally, everyone knows the margin for error is gone. Scale does not protect companies from mistakes. It amplifies them. At small size, errors are flexible. They can be reversed quietly, adjusted without headlines. At scale, every miscalculation becomes rigid. Systems are interconnected. Decisions ripple. Costs compound. What once required a correction now demands a restructuring. What once could be paused now requires unwinding entire operations. And unwinding at scale is not a technical problem. It's a political one. Jobs are tied to it. Reputations are tied to it. Public credibility is tied to it. This is why large companies often stay in losing positions longer than logic allows. Not because they don't see the problem, but because the cost of admitting it has grown too high. By now, failure isn't just possible, it's directional. The only remaining uncertainty is how visible it will be and who will be blamed when it finally arrives. The moment the outside world notices, everything changes, not because the problem is new, but because it can no longer be contained. Analysts begin asking sharper questions. Journalists stop repeating talking points. Earnings calls grow tense. Answers grow longer and less specific. This is when language becomes defensive. We're actively monitoring the situation. We're taking a disciplined approach. We remain confident in the long-term vision. These phrases sound reassuring, but to experienced listeners, they signal something else entirely. They signal control slipping. Internally, the company feels exposed. Decisions that once happened quietly now feel public, even when they aren't. Every move is weighed against how it will look, not just how it will work. And that shift is fatal, because once perception becomes a constraint, reality accelerates faster than leadership can manage. The story is no longer fully theirs to tell. Failure rarely arrives alone. It cascades. Confidence weakens, and capital becomes more cautious. Capital becomes cautious, and options narrow, and every decision carries more risk than before. Partners hesitate. Vendors tighten terms. Employees start asking quiet questions, not about growth, but about stability. Talent that once felt loyal begins watching exits. None of this makes headlines yet, but it reshapes the company from the inside out. The organization becomes reactive. Instead of setting direction, it responds to pressure. Instead of planning, it manages damage. This is where momentum turns negative, not suddenly, but persistently. And negative momentum is brutally hard to reverse because it feeds on itself. Every compromise weakens trust. Every delay increases doubt. By the time leadership realizes the cascade has begun, it's already moving faster than any single decision can stop. This is the stage most people remember, the visible cost. Projects are cut, teams are reduced, plans that once defined the future quietly disappear. The language changes again, this time permanently. Efficiency, focus, strategic realignment. These words sound rational, but behind them are consequences. Careers interrupted, trust broken, confidence lost, not just externally, but internally. And here's the hardest truth. By this point, none of these moves fix the original problem. They only manage its impact. The collapse didn't begin with layoffs. Layoffs are simply when a collapse becomes undeniable. What the public sees as the beginning is, in reality, the end of a process that started years earlier, quietly, predictably, and almost invisibly. In the end, collapse is never loud inside the company. It's quiet. Meetings grow shorter. Decisions feel heavier. The future stops being discussed in detail. What remains is triage. Leadership no longer asks how to win. They ask how to survive with the least damage. By now, the original vision is irrelevant. The market has rendered its verdict, not through headlines, but through pressure. Capital demands discipline. Employees demand clarity. The public demands answers, and there are no clean answers left. This is where myths die. The myth that scale guarantees safety. The myth that intelligence prevents failure. The myth that success buys immunity. What's left is reality. Stripped of optimism, stripped of narrative, stripped of excuses. The reckoning doesn't arrive as a single moment. It arrives as acceptance. Acceptance that the path chosen cannot deliver what was promised. Acceptance that time was misused. Acceptance that warning signs were seen and tolerated. This is the true cost of ignoring early signals. Not just lost money, lost optionality, lost trust, lost control. Every generation believes it will be different, smarter, faster, better informed. And yet, the pattern repeats. Because the failure of large organizations is rarely technical, it's behavioral. The inability to slow down while winning. The unwillingness to listen when success is loud. The refusal to act early, because acting early feels unnecessary until it feels impossible. The companies that survive downturns, disruptions, and pressure are not the boldest. They are the most honest. Honest about risk, honest about fragility, honest about what the numbers are actually saying. They treat warning signs as signals, not inconveniences. They value correction more than confidence. And they understand something most companies forget. Collapse is rarely caused by one bad decision. It's caused by many small ones that were allowed to continue because everything looked fine. If there's one advantage to understanding these patterns, it's this: you can see failure coming long before it announces itself. And once you see it, you never look at success the same way again.